Okay, we'll make a start, I think. So welcome everybody to today's webinar. So the topic is SMSFs, latest strategies and tips, and we've got a lot for you. So my name's Jeevan Tokhi. I'm the head of Simple Fund 360, and I'm joined today by Lyn Formica, who's head of SMSF Technical and Education Services. Welcome, Lyn.
Thank you, Jeevan. Thank you for having me.
Our pleasure. So for anyone who hasn't met Lyn before, so Lyn's obviously, as I mentioned, the head of SMSF Technical and Education Services with Heffron. So Heffron's a company committed to raising standards within the SMSF industry. Lyn's got over 25 years experience in, I suppose, about the super and SMSF industry. She's a regular presenter, so anyone attending sessions, either conducted by Heffron around the country, via accounting firms or run by professional bodies, you would have seen her around Australia. And she specialises in technical advice on any super matters to the accounting, legal and financial planning industries. Anything I've missed there, Lyn?
No, that's all good, but I actually might need to round up that 25 years. But anyway.
Okay, there you go. Over 25. Brilliant. So maybe Lyn, go to the next slide, and then so with today's webinar, the session will be recorded. So if you do miss any parts, don't worry, we will send you a copy of the recording, and it is something you can share with your colleagues. You will also receive a copy of today's slides that will be emailed out to everyone. So again, don't worry if you miss a certain section. We'd love any questions that you do have. So please enter any questions there into the Q&A panel. We've got Sean and Andrea joining us from Heffron to answer any questions that are technical in nature. And we also have Chow and Sid joining us to answer any BGL questions. Okay, maybe Lyn, you want to cover this one?
Excellent. Yes. Yeah, no, excellent. Thank you. So thank you, Jeevan, for having me. So today's session, we're going to walk through some of the tips and traps to essentially get you through till 30 June and beyond. We only have an hour, so we can't cover everything. But you do have any questions there, pop them through to Sean and Andrea, and they'll do their best to answer you, time permitting. So we're going to cover off on various areas around contributions, pensions, lodgements, the government's proposed tax changes as well. And the way we're going to do things is a little bit different in a sense that each of the sections, Jeevan's going to share a bit of his data in relation to what is extracted from BGL in relation to each of those topics, and then I'll cover the technical materials. So contributions, Jeevan, you've got some data for us in relation to contributions.
Yeah, so we looked at a lot of data here really across, combination 21 and 22 financial years. And as you can see, this was when contributions are posted or when is the transaction saved within BGL. So you can see really for the contributions in general, they are relatively uniform, really apart from June. So you can see, especially there with personal contributions, and that's both concessional and non-concessional, the majority are made in June, which is probably as expected. That's the end of the financial year for businesses. It's when a lot of the tax planning takes place. And an extension of that is even the contributions such as spouse contributions, directed termination payments, COVID recontribution, as we say, the majority are taking place there in June. There's a lot of obviously, tips about when is a contribution actually made, which Lyn's about to cover. And another interesting stat we sort of pulled out there is, leading up to the work test, which again Lyn's going to cover, is a proportion of the members which are, I suppose, eligible for the work test is roughly around 20%. So it is sort of a large majority that are still sort of covered there. But Lyn, back to you. Obviously, 30th of June this year is a Tuesday, but that means obviously we don't have to worry about the weekend. But what other things do we have to worry about?
Yeah. So I mean, it's I know why people make contributions in June, but that's often our timing problem, because it's essential that our contributions are made in a particular financial year if we want to count them to that year's contributions caps, or we claim them as a tax deduction in that particular year. So the contribution needs to be made, and made has some different connotations depending on how you make the contribution. But generally speaking, we want to make sure that's received by the superannuation fund by the 30th of June. The most common problem areas that we have usually is around clearinghouses. So when an employer is making a contribution via a clearinghouse, they're going to deposit the money with the clearinghouse thinking they've done everything they have to make that superannuation contribution. But the clearinghouse then has to make a transfer from their clearinghouse through to the superannuation fund, and then the fund will eventually be credited with the money. So our contribution isn't actually considered to be made technically until the fund is credited with the money, which it can take some time. It can take a week week or sometimes even more for the monies to get from the clearinghouse or from the employer through the clearinghouse into the superannuation fund. Which can give us some timing issues if that ends up in the next financial year. So if you do have clients who are using the ATO Small Business Super Clearinghouse, yes, we have different rules. So your SG obligations will be satisfied for that employer when they make the payment through to the clearinghouse. And these days we have a PCG 2020/6 that even says that the employer can claim a tax deduction for that superannuation contribution when they pay the money to the clearinghouse. But that only applies where we use the ATO Small Business Clearinghouse. For other purposes, contribution is not made until the fund receives the money. And either way, for cap purposes, it doesn't count for your contribution cap until the fund actually receives the money. So really just important to make sure that clients are allowing plenty of time to get those contributions in. The other area that I wanted to cover off on is in relation to eligibility, because we have had some significant changes. They were back on the 1st of July 2022, but we're still trying to grapple with what they mean. And essentially, trustees can now accept contributions for members aged 67 to 74 without them needing to meet a work test. So essentially, auditors aren't going to be asking for a work test declaration from your superannuation fund clients in the 22-23 or for the 22-23 financial year and going forwards. It's only if it's a personal contribution and the member wants to claim a personal tax deduction for it, will that person need to have met the work test in that particular financial year. Otherwise, their tax deduction will be denied. So that's now moving it from a CIS obligation around trustees being able to accept the contribution through to an ATO Tax Act provision about whether you get to claim a tax deduction for the superannuation contribution or not. So ATO have said they will be checking, they'll be looking to see what evidence they can see in terms of whether this person has met the work test. So they're going to be looking at personal income tax returns, looking for salary or wage type income, business income, for example. From that, they can't determine that you've done the 40 hours requirement, but if it's just dividends or distributions that are appearing in the tax return, it seems fairly obvious that you've probably not met the work test, and that's when questions are going to be asked. The other area that I'm seeing still some problems with, and it's not a change, but this is what happens when the member reaches 75. So once the member turns 75, or more technically, it's the 28th day after the month in which they turn 75. So if I was turning 75 today on the 4th of April, 28th of May would be my cutoff point. From that date onwards, contributions can't be accepted from employers unless they're SG or they're mandated contributions. And that's regardless of whether that person meets the work test or not. So they can't have voluntary employer contributions, salary sacrifice type contributions. The only contributions a trustee can accept are those where they relate to SG or mandated award type of contributions. So I always feel uncomfortable when I see a contribution coming in and it's a flat $27,500 and someone tells me it's an SG contribution. Not likely. So be really mindful of making sure that your clients are only accepting, the trustees are only accepting SG or mandated contributions once we hit that age 75 bracket, as I said, regardless of whether they meet the work test or not. Because once we hit that 75, SG mandated and Downsizer contributions are pretty much the only types of contributions that can be accepted. One of the other areas that we've got some significant change at the moment is in relation to non-concessional contributions and the triggering of the bring forward mode. So I've got the current thresholds on the right-hand side of that slide. So essentially, we would know that if our client's total superannuation balance is more than $1.7 million at 30 June 2022, then their non-concessional contribution cap is 0. So we effectively say to the client, you can't make non-concessional contributions because otherwise you're going to give rise to an excess non-concessional contribution. Whereas if their total superannuation balance is less than 1.48 million at 30 June 2022, then they've got a non-concessional contribution cap of $330,000 and a 3-year bring forward mode. And remember as well that the other change that was made that we can trigger bring forward mode right through to the year that we're turning age 75. Now that $1.7 million is actually linked to the general transfer balance cap. And we know that the general transfer balance cap is being indexed on the 1st of July this year to $1.9 million. So that obviously has implications for commencing pensions, those sorts of things, but it also has implications for the thresholds for our non-concessional contributions. So you can see on the left-hand side of that table, I've got what the thresholds are going to be for next financial year. So next financial year, the question is going to be asked is, what's my total superannuation balance at 30 June 2023? Is it 1.9 or more? In which case, then I've got a zero cap. But you can see there's a $200,000 difference there. So there's potentially clients who are not able to make contributions, non-concessional contributions in the current year because their cap is zero, who may well have the opportunity to do non-concessional contributions next year. So you might have a look at my example of Elaine. She's retired, she's 68, doesn't need to meet a work test to put a non-concessional contribution or have a non-concessional contribution accepted. Her personal transfer balance cap is 1.6. She's fully utilised it, but she's not in bring forward mode. She hasn't made non-concessional contributions for a few years. Her total superannuation balance at 30 June 2022 happens to be 1.76 million. So unfortunately, it's over the 1.7 because she's asking the question, can she put a non-concessional contribution in this current financial year? But unfortunately, the answer for Elaine is zero. So she's actually wanting to do a withdrawal and recontribution strategy. She can't do that in this current financial year. If she takes the withdrawal, she won't be able to get the money back in without giving rise to a cap breach. But if we project forward and we're thinking her balance is actually going to be about 1.86 at 30 June 2023, fortunately under the new threshold of $1.9 million for next financial year. So that's going to give her the opportunity of a non-concessional contribution of, say, $110,000 next financial year. So when I'm having the conversation with Elaine, is like, well, it's zero for this year, but don't panic. Next year, you might have the opportunity for 110. And depending on how low we can get our total superannuation balance down, if we can get it down to 1.68 and under, then she could potentially have a $330,000 non-concessional contribution cap. So making sure that clients are aware of those rules, it might be that Elaine has to take a withdrawal before 30 June, just to make sure that she gets herself under the thresholds that she wants to be under to then be able to utilise those non-concessional contribution caps. So revisiting those clients who you've been telling them for the last couple of years, their cap is zero, they may very well have the opportunity next financial year. And Jeevan, you've got some data around downsizer contributions.
Yeah, first of all, apologies. I was looking at the wrong month too. So 30th of June is a Friday this year. So probably more importantly, timing is of the essence and of importance. So with the downsizer contributions, obviously a lot, the stats aren't too interesting, but we can see the highest levels there are 71 and 72 of those making a particular downsizer contribution. We are now starting to see those that are 55 and above starting to utilize this, and we're seeing as high as age 95 also utilizing this. But obviously we can see probably as expected, in that prime sort of retirement bracket between 65 and 75, we're seeing obviously that's where the majority of these contributions are made. Yeah.
Thanks, Jeevan. Yeah, it's really, really interesting, particularly those upper age brackets, because downsizer contributions don't have an upper age limit. So remember, downsizer contributions are for those people who have sold an asset, a dwelling that at least partially qualified for the CGT main residence exemption. They've owned it for at least 10 years, or they or their spouse have owned it for at least 10 years. And then they've got the opportunity for their own special lifetime cap of $300,000. Not counted towards your non-concessional contribution cap, but for every other reason, it looks like a non-concessional contribution because it's tax-free going into the fund and creates tax-free component. The important part is the fact that this contribution isn't subject to the member's total superannuation balance, or eligibility is not subject to the member's total superannuation balance. So downsizer contribution for some clients might be the only type of contribution they're able to make because their total superannuation balance is quite high. And effective the 1st of January 2023, the eligibility age reduced to age 55. So it used to be 60. Prior to that, it was 65, but it's all the way down to 55 now. So I could see in your data, Jeevan, that you had someone at 55 who's already made a downsizer contribution. So just making sure that you're aware of that rule change. I just want to move over now to pensions. And so, Jeevan, if you can share your data, and then we'll talk about some of the rules.
Yeah, so I guess very similar to the contributions, we do see this relatively uniform and probably as expected. But obviously the largest amounts of pension payments are made in the month of June. This is obviously most likely those trying to make sure that the minimums have been met. I guess from that perspective, and I think go across to the next slide there, Lynn.
Sorry.
Yep. So two other sort of small stats there is we're saying just over 50% is the proportion of members who draw more than their minimum. So obviously those are the remaining are just drawing the base minimum, and obviously the importance of the transfer balance cap. We can see the number of members who are drawing a pension who have also utilised their transfer balance cap. So obviously have 0% remaining within their cap.
Thank you. Yeah. So yes, that timing is critical. Just like contributions, withdrawal of your pension is just as critical, because pensions have to be paid by the 30th of June, or the minimum has to be paid by the 30th of June. So again, usual problems are where we've got electronic funds transfers. We need to make sure that they have at least left the fund by the 30th of June. So making an EFT on the Friday of the 30th of June may not cut it. Just another reminder as well about the fact that pension payments have to be made in cash. So to count as a pension, it needs to be a cash payment. If someone's doing an in specie transfer where they're transferring an asset out of the fund as part of a member benefit, that needs to be a lump sum from accumulation or a partial commutation from that pension. We just cannot treat an in specie payment as a pension payment. The other question that we're getting quite commonly at the moment is in relation to the drawdown rates. So we've had the halving of the drawdown rates for I think 4 financial years. And the questions are around, are we going to return to normal from the 1st of July? So certainly the way the legislation is currently worded, the halving ceases the 30th of June this year. So the government would have to do something different. They would have to amend the law to allow the halving to continue next financial year. I was very surprised that they continued it for this financial year. I'd be very surprised if they continue it for next financial year. So that's again just something to warn clients about when you're doing their planning before 30th of June, because they've become probably fairly used to taking $50,000 from the fund instead of $100,000 from the fund, because they've had 4 years of these particular rules. They may have even forgotten what a real amount of minimum pension looks like. So if you've got clients wanting to take large amounts before the 30th of June, just walking them through what their minimum is likely to be for next financial year, just to make sure that they're not ending up taking more money out than they had anticipated. They might wait for that large withdrawal to, part of it be in July or something like that, so it'll count towards next year's minimums. Those interesting stats that Jeevan had in terms of the fact that 53% of people are taking more than their minimum each year. Well, then the question becomes, what do we treat that as? What is that excess that amount in excess of the minimum? What should we do with that? So one of the options, of course, is treating it as a pension payment. Certainly is the simplest option. It's tax-free for the member if they're over age 60, and I don't have any extra paperwork to prepare. So a lot of us default to that. But there are disadvantages to that, because I'm not going to claw back any transfer balance cap space. I don't get a debit to my transfer balance account if I take a pension payment. So that could be detrimental for the client, depending on their balances and likely to receive an inheritance of superannuation or not. If I'm eating away at my pension balance as well, I'm potentially reducing my actuarial certificate percentage, my exempt income percentage, if I've also got accumulation balances in the fund. So I'm depleting the pension balances faster than I'm depleting the accumulation balances, then I'm going to get a lower percentage each year. So there might be better alternatives to just the simplistic treated as a pension payment option. Lump sum from accumulation might be an option if your client's got an accumulation account. Again, still tax-free, potentially increasing the tax exemption percentage inside the fund, because I'm depleting that balance that's not generating a tax-exempt income inside my fund. Most people balk at the fact that there's paperwork that's needed. A lump sum from accumulation, most certainly I need some paperwork, but there's simpler ways to do that paperwork. You might consider what we call standing instructions, where you have instructions from the member to the trustee that basically says, every time I take a payment from the fund in this particular financial year, in the first instance, a minimum from my pension, otherwise, please take it as a lump sum from my accumulation account. That paperwork's then only needed once in the financial year. The other third option is a partial commutation from that pension. Advantage being that it claws back some transfer balance cap space. So that might be advantageous, as I said, if the client's got large superannuation balances, likely to inherit superannuation from a spouse, for example. We just do need to be careful with partial commutations, because every payment from a pension account is a pension payment unless the member elects otherwise in advance of the payment coming out. So it's not something that we can decide after the event. Before they take the payment, the member needs to be giving clear instructions to the trustee as how they want that payment taken. So we just need to be mindful of our conversation with clients. We don't want the conversation to go, hey, Fred, that 20 grand that you took in excess of the minimum, what do you want me to do with that? How would you like that to be treated? We need to rephrase that. Fred, that $20,000 that you took in excess of the minimum, how had you intended that payment to be taken? Reflecting back on what their intentions were before they took the payment. And again, we need the paperwork to match that. So again, consider those standing instructions where this time it'll be a little bit more advanced in the sense of, in the first instance, it's a pension payment until I reach my minimum. Then I want a lump sum from my accumulation account if I happen to have one. If I've exhausted my accumulation account, then please make it a partial commutation from my pension. Once we put that in place, we just then need to make sure that we're processing the withdrawals in accordance with those instructions. If we're eating away at the pension balance and we still have an accumulation balance, and again, we're not necessarily maximising the tax position for the fund or minimising the tax position for the fund. And with all of those three options, we just need to be really mindful that this is the decision for the client. So the client should be giving you instructions about how they want those payments treated, because it's not all necessarily about tax. We can't just simply base it on the tax position of the fund. There could be estate planning consequences of eating away at a particular pension account versus an accumulation account. So always mindful that we're putting putting ourselves at risk there to be taking on an obligation that's, wasn't part of our engagement agreement. As I said, transfer balance cap is increasing effective the 1st of July 2023 from 1.7 to 1.9. So that's going to have a flow-on effect for all of our clients as to what their personal transfer balance cap is. You may have many clients like Lyn in my example before, whose personal transfer balance cap is 1.6. She had fully utilised it in the past prior to the 1st of July 2021 when the cap was 1.6. So she's stuck at 1.6. She doesn't get any of the benefit of any indexation. We'll have other clients who fully utilised their cap when it was 1.7 between 1 July 2021 and this year. And then we'll have other clients who've never had any entries going into their transfer balance account, never had a retirement phase pension starting for them, those sorts of things, a TRIS converting to a retirement phase pension. So they have their full $1.9 million cap available to them. And everyone else is going to be somewhere in between. So we're going to be able to go to the ATO eventually to get the information to see what your client's index transfer balance cap is. But of course, that information is only as good as what's been reported to the tax office. So if there's entries that are missing, if there are pension commencements, pension commutations, reversion of a pension that hasn't been reported, then the ATO's data will be incorrect. So we just need to be very mindful of comparing that information, even once the ATO's records have now calculated the 1 July 2023 figure. Of course, remembering that indexation is only based on the lowest ever cap space that you've got left. So we can't do anything now in terms of turning off pensions to create more cap space. The only thing that we can consider is not necessarily starting a pension before the 1st of July if we haven't had any other pensions commenced and those sorts of things. But there's a trade-off there in terms of what the exempt income may happen to look like. Whilst we're talking about transfer balance accounts, just a reminder that there are some changes coming to TBARs, transfer balance account reports. So they're changing the lodgement due dates. So under our existing system, our funds are either annual or quarterly reporters. And that would have been based on what the fund's total superannuation balance, what the members' total superannuation balance was at the 30 June of the year before they had their first event, their first pension commencement, for example. Throw all of those rules in the bin, effective the 1st of July 2023. All of our superannuation funds will all be quarterly reporters. There'll be no concept of an annual reporter going forward. So everyone will be in a system where events have to be reported by the 28th day of the following quarter. But of course, we're only reporting pension commencements, pension commutations, reversions of pensions, TRISs that weren't yet in retirement phase that have become retirement phase pensions, those sorts of things. We don't lodge TBARs for pension payments, for example. So not everyone is needing to have a TBAR that's lodged, but we do need to be mindful that we need to be moving to this system or getting our business into the position where we're moving to that system. Under the transitional rules, events that have happened in 22-23, they'll all need to be reported by the 28th of October 2023 at the latest. You might be thinking, am I, late lodgement penalties coming up here because there's no chance I've got to be able to report all my events by the 28th of October. My understanding is that the ATO is still in what they call educative and supportive mode in relation to TBARs. They will move away from that. I'm not suggesting that it's imminent, but they will move away from that. And in terms of penalties, you're much less likely to be able to, much more likely to get a reduction in penalties if you can show that as a business you've got a system that usually reports on time. We just have the straggler clients that we don't get information for. The next area that I wanted to share some tips in relation to is the importance of lodgement. Now, I know we all know how important it is that we lodge our SMSF annual returns on time, but we've got some proposed changes that are coming that may make it even more important that we lodge in time. So we've got, trustees can be penalised, late lodgement penalties, even administrative penalties if we're continuously late lodging. And our fund status on Superfund lookup can be changed to regulation details removed. Once that happens, most employers won't make superannuation contributions to that fund, can't receive rollovers in from other funds. And usually that status changes if we're 2 weeks or more late. They did that on the first business day of the month. We've got a fund at the moment that has a couple of years worth of returns outstanding. Regulation details have been removed, can't get contributions going into the superannuation fund, meaning they don't have the cash flow to make the payments under the fund's LRBA. So we're in a position where the bank is threatening to foreclose on this loan arrangement simply because we haven't lodged returns on time and the flow-on impact from that. As I said, it potentially is going to get worse because there's a proposal out there. We've had exposure draft legislation where the fund's ABN could be cancelled if 2 or more years worth of returns are outstanding. So ABN gets cancelled, that could have flow-on implications. For example, if I've got a self-managed super fund that has a property, tenant would be required to take out withholding tax from the rent before they paid it through to the SMSF landlord. How would we remit our GST if we didn't have an ABN, those sorts of things. So they make it very hard for any transactions to happen in relation to that fund if our ABN has been cancelled. So just another reason to keep pushing forward to getting your lodgements in there. And Jeevan, your data is quite interesting.
It is interesting. So obviously the lodgements for the 2022 year, looking at the same months post 1st of July when that return can first be lodged. The 22 years, the lodgements are ahead of what we saw with the 21. Obviously during, a combination, I think, of COVID and lockdowns, the 2020 returns were definitely far behind what was done the previous year in terms of 2019. 21 was probably on par or a little bit higher, but it's good to see. I suppose 22 is probably heading back towards where we could deem to be within a normal range.
Yeah, that's good. It's good. I'm pleased that everybody is moving. We hear so much about the difficulties in terms of finding staff and those sorts of things. I can only assume that you're prioritising your self-managed superannuation funds over your other clients to get these data happening the way it is. Yeah. What I wanted to cover off on next in relation to what I'm calling non-standard investments. So, what's those things that are a little bit odd? Crypto, collectibles, shares in private companies, unlisted companies, units in private unit trusts, whether they're related unit trusts or not, even property type investments is what I'm putting in the non-standard category. And Jeevan, you've got some comparisons between ATO and those sorts of things.
Yeah, so this one I took a little bit different approach. I took the stats from the annual returns out of BGL, and also, took a combination of the ATO stats that they publish at the end of each quarter. A couple of things there with those non-standard investments. So you can see cryptocurrency and collectibles. The majority of funds that hold those usually have a balance of less than 200K. So obviously what's normally deemed as the unofficial minimum, for an SMSF. So we can see the majority of the funds, obviously maybe with a higher risk appetite are those that are below. And we're seeing even those with less than 50K, obviously heavily involved there with crypto. Across the probably things such as collectibles, that's obviously again the lower the fund balance, the higher the proportion of assets that is across the base. With cash balances, again, probably as expected, the lower fund balances have higher cash balances, probably not utilizing their full investment strategy yet. And the higher the proportion, or the higher the fund balance, the less the proportion of cash we are seeing. For things such as property, what we are seeing is those with fund balances between 200K and 2 million have a higher appetite there for residential properties and LRBAs. Those that have a fund balance between 500K through to 50 million, the large balances, obviously a larger appetite there with commercial and farming. And for unlisted shares, we are seeing a much larger proportion with those in that high risk, not high risk, the higher fund balances in terms of $5 million plus. In the section you're going to cover next in terms of large super fund balances, I think the three categories we saw the highest proportions there are unlisted trusts, ASX shares, and non-residential property.
Yeah, excellent. It's quite interesting. As you say, those larger funds tend to be with those more illiquid type of assets, if I can call them that, in terms of the commercial properties, perhaps the unlisted entities, those sorts of things. So the first one to cover off on is what the common areas where I see people coming unstuck a little bit, putting SIS compliance, in-house asset rules, all of those sorts of things to the side, basic compliance areas that we come unstuck where we've got these non-standard investments inside our superannuation fund. The first port of call is usually an investment strategy. The moment you have any of these non-standard investments inside the self-managed super fund, the trustees need to be looking at their investment strategy. And usually the issues are diversification, liquidity, and risk. And more often than not, those things aren't addressed or correctly addressed, adequately addressed when we've got those non-standard investments. Now, I'm not saying there's anything wrong with any of those investments. I'm just saying they're the categories that normally get pulled up where we haven't given appropriate consideration to diversification, for example, which is, it's quite strange because I could have a self-managed super fund that's predominantly in term deposits. And my auditor often doesn't, or rarely would pull me up to say that, you haven't covered diversification here. And it's just because it's a different type of asset. Yes, I agree with you, potentially would have diversification issues in relation to term deposits. And I probably should have my investment strategy better worded to cater for that. But it's usually not the area that's, commonly pulled up. The other area that we tend to fall down is in relation to valuation of assets. So trustees must ensure the assets of the fund are valued at market value in the fund's financial statements and whenever pensions are commencing. And that can be difficult when we have things that aren't listed shares, term deposits and cash, for example. It is the trustee's obligation to provide objective and supportable evidence to the auditor to support valuations. And, I'm not going to go through the ATO's guidelines. You can Google ATO SMSF valuation guidelines and they'll all be there in terms of what qualifies as objective and supportable evidence. But a reminder that if your client is saying to you, I don't think the value of the property has changed in the last 12 months, we need evidence for that. Thank you, Fred, but can you give me the evidence that backs up your claim that the property hasn't changed in value? So it's not enough to just have a minute that says, we don't think the value of the property's changed. We also need to have the evidence, the Google searches, the RP data reports, whatever it happens to be, to give us the evidence that there has been no change in value. Or the fact that there has been a change in value. And I just want to share with you a scenario that we're seeing a bit commonly at the moment and the risk areas that might be involved in this. This is where we've got a self-managed super fund that's predominantly invested in a single property. So the SMSF financial statements for 2021 recorded a value of $1.5 million for that particular property. And that was based on an appraisal, a curbside appraisal back in October 2020. So it's about 9 months difference between that appraisal and 30 June 2021, which we were using, when we were using it. We've just completed the SMSF financials for 21-22, and it records a value at $4 million. Now that's based on a formal valuation that was obtained for that property in November 2022. What could happen now? So essentially, if I lodge this SMSF annual return reporting a value of $4 million for this property, when the previous year it said we're 1.5, it's going to show a very enormous return for this superannuation fund, which may very well be genuine. But we have to be mindful that that might raise some questions for the ATO when they see these enormous returns inside superannuation funds, because they then look to question, is this true? Is the prior year valuation correct? So was that valuation of 1.5 at 30 June 2021, was that right? Was that appraisal back in October 2020, was that too old? Did it have the comparable sales data on it? Those sorts of things. Was it a reliable source of evidence for that $1.5 million? The risk is that the ATO says, you know what, we don't think that property is worth 1.5 at 30 June 2021. We think it was worth $2 million, for example. That's going to become a problem for our client if, for example, they've made non-concessional contributions in 21-22, thinking that their balance was only 1.5, and therefore they qualified for not, a $330,000. Actually, it wouldn't be 330, but something more than 110 in terms of non-concessional contributions. It might even be a pension fund, and our minimum pension has been based on the 1.5, and we've only taken the minimum. So if we've only taken the minimum, ATO says, no, it wasn't worth 1.5, it was 2. We've failed to pay enough minimum, and therefore we lose our eCPI. So there's just some risk factors that we need to think through. We need to look at the clients. When you're doing a review of a fund and you see large returns, whether it's from a property, a revaluation of shares in an unlisted company, those sorts of things, if there's been a big spike in return, have a bit of a think about, are there questions that are going to be asked here? We can't do anything about that 1.5. We've already lodged it, but we can at least start asking questions before the ATO starts asking questions. The one that we were dealing with, we actually reviewed the valuation and actually looked at it and said, I don't think that $4 million is correct. When we looked at the data, it was based on a usage for the property that they weren't actually permitted to do. So just making sure that you're asking all those questions before you're lodging returns. Even simple things. What if the client had taken more than the minimum and we were going to treat the excess as a lump sum from accumulation? We might take it as a pension payment just to buy us some space, just in case the ATO questioned that $1.5 million valuation. So a bit of a risk assessment going on before you lodge returns, so you are aware of what the consequences might be should the ATO start asking questions. All right, so my final topic for today was the government's proposed tax changes. So their proposal to reduce the tax concessions for those with total superannuation balances of more than $3 million, effective from the 1st of July 2025. Jeevan, you were able to pull some data for us around the $3 million. Not perfect, but it gives us a bit of a glean about the types of clients or the number of clients we might have with this problem.
Yeah, so Treasury in their announcements say there's 80,000 individuals that this will apply to based on their current balances. It's not obviously projected balances. What we tried to do here, obviously because we don't have every single SMSF on our platform, although we'd like that, we just tried to take a estimation of how many SMSFs we thought would apply during those, obviously, in those particular ranges there. So perhaps I should have probably looked at another range between just under 3 mil as well. But there's definitely a lot of SMSFs between 2 million and 5 million balances, even looking at the ATO stats. And obviously, based on a proportion of assets, obviously those funds have those funds, 5 million plus, have a larger proportion of assets, which is why they're obviously a high target for the government.
Yeah, definitely. So let's just work through what they're proposing so we can understand where we go to from here in relation to these changes. So there are three essential elements to this change, but as I said, it only impacts individuals with a total superannuation balance of more than $3 million. So the general concept is that those people who are impacted are going to pay an extra 15% tax on some of the earnings in their superannuation fund. Now, it is not a change to the way superannuation funds are taxed. Superannuation funds will be taxed the same way that we have always treated them, in terms of, a CGT discount if we've owned the asset for more than 12 months. We get ECPI if we've got a retirement phase pension in the fund, those sorts of things. Those rules will stand. We have got a completely different tax here. It's a brand new tax. I was calling it the special extra tax because it doesn't have a name yet. But it'll be a 15% tax on some of the earnings inside the superannuation fund. The bill for this tax will be sent to the member personally. So it's like Div 293. So, your high income earners who pay an extra 15% tax on their superannuation contributions. The first 15% is paid by the super fund. The other 15% is a bill sent to the member personally. Same concept here. If we've got a client who is liable to pay this tax, they personally will get the bill for it, not their superannuation fund. They can, though, they'll have the ability to go to their superannuation fund and ask the fund to release monies from super to pay the tax bill, like we can do with Div 293, that whole release authority concept that we currently have. The $3 million threshold is not proposed to be indexed. So as Jeevan said, they're initially predicting about 80,000 people to be impacted. Over time, more and more people will be impacted because they're not planning to index the threshold. So I said that some of the earnings are going to be subject to this tax. Well, how much of the members' earnings are going to be subject to this tax? Well, we just do it as an example. Brad's got $5.5 million in super at 30 June 2026. That's the critical date. The rules start 1 July 2025, but it's his balance at 30 June 2026 that will be critical here. It's whether that balance is less than $3 million or not. His was not. It was $5.5 million. So we then have to work out what share of his earnings in 25-26 will be subject to the new tax. And essentially what we're trying to work out here with this formula is how much of Brad's balance is in excess of the $3 million threshold. So we take his closing balance at 30 June 2026, take away the $3 million threshold over his total balance at that date, and we work out that approximately 45% of his balance is in excess of the $3 million threshold. And that's a calculation that would be done each year. So what is these earnings? So a share of the earnings, some of the earnings is going to be taxed at the 15% rate. What's the earnings? So this is the controversial part in the whole proposal. So if we think about a member statement for Brad, combining all of his superannuation accounts, would have his balance at the start of the year, pension and accumulation, because it's based on total superannuation balance. Brad might have some contributions going in. We take off contributions tax. So might have some pension payments, some lump sum withdrawals. And then we've got the net earnings of the fund, or the allocation to Brad's member account. So the share of net earnings, net income that's been allocated to Brad. Then we get his balance at the end of the year. Well, it's that earnings figure that's going to be taxed. So essentially, earnings are anything that makes Brad's account balance go up or fall. It's growth in assets, including unrealized capital gains. So it's basically any movement in the balance from start to end, taking away contributions, adding back our withdrawals. To get that figure. So as I said, it's paper gains, not necessarily realized gains as well, but paper gains most certainly is caught up in this earnings figure. Now, not all of that earnings will be taxed, part of it, but let's do a calculation for Brad. So he's got a balance at the start of the year of $5 million, $2 million in pension, $3 million in accumulation. And as I said, his balance at 30 June 2026 is $5.5 million. He had a $300,000 downsizer contribution. Remember, of course, someone like Brad, very limited opportunity for contributions. Downsizers, concessional contributions is really it for him, given the size of his total superannuation balance. He's had withdrawals of about $100,000 from his pension. We just simply do the sums. We do the formula. So we take closing balance, take away opening balance, remove those contributions, add back the pension payments, and we get earnings of $300,000. Now, not all of that's going to be taxed at 15%, but basically Brad's earning figure for 25-26 is $300,000. That's not suggesting that the fund's taxable income was anywhere like $300,000, because that $300,000 could be made up of a change in the value of the assets of his fund, so paper gains in that particular financial year. But in terms of how much of that 300 grand Brad gets taxed on, we go back to that formula. So we said that 45% approximately, his balance at 30 June 2026 is approximately 45% above the $3 million threshold, or 45% of his balance at the end of the year is above the threshold. So 45% times the 300 grand's worth of earnings in 25-26 times by the 15% tax rate. And Brad's got a tax bill of about 20 grand for 25-26. Now, this will happen each and every year that his balance is in excess of $3 million at the end of the financial year. And as I said, Brad gets that tax bill personally. Brad can ask his superannuation fund to pay for it. The problem might be that fund doesn't have the cash flow to pay that tax, because that tax could predominantly have come about by movements in the value of an asset rather than asset actually having been sold. Where balances are much larger, you can conceive a situation where a fund would be forced to sell an asset to pay the tax the tax bill that Brad got based on paper gains inside the superannuation fund. You might be thinking, well, what happens when the assets go down in value next year? So let's assume that Brad's balance dropped to 5.2. So it was 5.5 at the start of the financial year. Again, a mixture between pension and accumulation. He didn't have any contributions this year, but we still took some 100-odd grand out of his pension. Usual formula: closing balance, take away opening balance, add back those withdrawals. We get negative $200,000 this year. Brad's fund has gone backwards. Those changes in market movements disappeared. So the asset that had gone up in value at 30 June 2026 is no longer up in value at 30 June 2027. So last year's gains have been lost. What happens when that happens? Well, based on the consultation paper that's been released so far, Brad doesn't get a refund of that $20,000 worth of tax that he paid. Essentially, he'll have a $200,000 loss, which will carry forward, which can be offset against future earnings for this proposal. So it's not a 200 grand loss like we think about it in terms of capital losses. This is not the superannuation fund's loss. This is Brad's earnings loss to then be offset against future earnings following this formula under this new tax mechanism. There might conceivably the situation where Brad doesn't have any earnings in the future. It might be that Brad's balance, he takes a lot of money out of superannuation and his balance is under $3 million. So he's not in the regime anymore. Or it might be that that spike in value that he paid 20 grand on is a furphy. You know, it never recovered again. In case there's never any future earnings for him. Based on the consultation to date, it's a bit of a so sad, too bad, unfortunately, at the moment. Brad doesn't get a refund of that tax that he paid. He's just got that carry forward loss, which may be not much good to him unless he's got future growth. So in terms of where we're at now, as I said, a consultation paper has been issued. So we had the original fact sheet from the government. We then had a consultation paper released late last week. Very, very short consultation period. It closes on the 17th of April. So there is consultation going on, people putting their submissions in. My understanding is the consultation period is probably quite short because they want to model any tweaks, changes they might make to the announcement before the budget in May. So will there be changes? I'm not sure. So certainly there've been some slight modifications or clarifications between the fact sheet coming out and the consultation paper. Things like we didn't know what would happen, for example, if you had insurance inside your superannuation fund, TPD insurance, for example, inside your superannuation fund, and a claim was made on that policy, and $1 million got added to your account. Would that be counted as a contribution? Because it's not a contribution normally. Normally, it's just earnings allocation inside the superannuation fund. They've since clarified that they would count that as contributions, so you didn't end up paying tax on the insurance proceeds. But there's a lot of other clarification that still needs to come about what certain amounts coming in and out of superannuation funds or certain odd situations, how they're going to be treated under this proposal. But for the moment, I would be saying it's too early for clients to be pulling money out of superannuation now. Certainly when the announcement was first put out there, we had clients saying, well, I'm just going to rip all the money out in excess of $3 million, those sorts of things. And certainly that may be a conclusion that someone comes to once this is all legislated. So it's a proposal. It has to go through the parliamentary process, be legislated. It's got a start date of 1 July 2025. There will be an election before then. Not sure we'll have a change in government, but there'll certainly be an election before 1 July 2025. So if it becomes appropriate to be withdrawing monies out of super over $3 million, there's plenty of time for that. They'll need to get that money out before 30 June 2026 based on what's been released to date. So there's plenty of time to be taking a withdrawal. Clients might also be rethinking, well, should I be adding any monies to super? Should I still be putting in that contribution that I had planned to? Again, if you've got clients who are eligible to withdraw or will be eligible to withdraw their superannuation in the near future, I probably wouldn't be stopping adding contributions to super or adding monies to super. There'll be a reason why I'm putting that contribution in. It might be a concessional contribution because I'm trying to get a tax deduction for something right now. There's still a benefit in getting that tax deduction right now. It might be a downsizer contribution. So I have a very limited window to put downsizer contributions in. I've got 90 days from settlement. If I don't put the contribution in within that time period, then I'm not entitled to make a downsizer contribution. So I'll lose that opportunity. So I would still be putting the contributions in. And again, as I said, if in the fullness of time when we know all there is to know about this new tax, if it's appropriate to take money out of super, then they can always take it back out before the rules start. What becomes more critical is the evening up of superannuation balances. The last thing we want is, member A to have $4 million in super and spouse member B to have $1 million in super. Member A being subject to this new tax and member B being well under the threshold. Just like we try to even up balances for transfer balance cap purposes, for the $500,000 threshold for catch-up contributions, those sorts of things. This is just another reason why we try to even up balances. So cash flow, age, cap permitting, we might be trying to get member A with the $4 million to take a withdrawal and recontribute it in member B's name. We've got a couple of years to do that before the starting of 30 June, before that cutoff of 30 June 2026. So we might, that's where we should be focusing our attention rather than not adding to money to superannuation at the moment. So we've got some content coming to the Super Companion after Easter, which is going to cover off on all of the proposed tax changes, what we know of them, those sorts of things. So if you're a subscriber to the Heffron Super Companion, our online encyclopedia about all things superannuation, that's the place to go to. That's where we will continue updating, where we get answers to questions when we're participating in consultation and we get an answer to a question. That's where we'll pop it. So if you have got clients who are impacted by this change, jumping into the Super Companion to watch out for those changes. So, Jeevan, we've got 5 minutes time. Actually, maybe I should be asking the question of Sean and Andrea. I know they've been madly typing away, answering questions, but if there's something that you wanted to bring to our attention?
Well, one question's popped up a few times. A lot of people were late today, and we're asking, is there a recording of today's session? So I'll just repeat that. There is a recording of today's session, will be sent to all attendees along with a copy of the slides. So that'll be sent out later this week, and we'll send any relevant links in that email as well.
Excellent. Yeah.
Maybe I'll ask a couple, maybe around the 3 million that we've got there. So covered. So the tax or the tax loss, will that go on an individual tax return?
I'm not sure exactly where it's going to go, but it's the ATO's responsibility to record that information, to collate that information. It's not the superannuation fund's responsibility. Whether they'll record it on tax returns so we have that information, I'm not sure. I don't expect so, because it's completely separate from their income tax liability. So, for example, if Brad gets the bill for 20 grand, he can't use franking credits from shares that he owns in his own name or tax losses in his own name to offset that 20 grand tax bill. So completely separate to his personal income tax. Where they record it, I'm not sure at this stage.
There was a couple of questions there too about how will all this information be recorded by the ATO, which is, I think, a bit of an unknown at the moment, but I don't know if there's any commentary around that.
Yeah, I mean, it's that the reason the ATO have come up with this system is because we have this total superannuation balance system. It wasn't what it was originally designed for, but certainly funds, self-managed super funds and APRA superannuation funds, we report total superannuation balances. Self-managed superannuation funds report contributions, we record withdrawals, those sorts of things. So there might be some change needed in the APRA fund reporting, because they don't necessarily report withdrawals through to the ATO for members over 60, those sorts of things. So there might be some few tweaks. We might have changes to the SMSF Annual Return, might be changes to what APRA funds report, but then ultimately the ATO responsible for working out what the earnings figure was for that particular member.
Maybe another question that's probably just clarifying. There's a few questions there that what happens where individuals have multiple SMSFs or an SMSF and an APRA fund?
Yeah, so it's total superannuation balance. So just like we do with working out whether someone has some non-concessional contribution cap space available, what their non-concessional contribution cap is, we add all of the balances together. So balances in SMSFs, balances in APRA funds, we add them together. Doesn't matter whether it's a retirement phase pension account, an account-based pension account, or an accumulation balance, we add them together. The only part we don't have clarity on the moment is defined benefit funds, or the big public sector type of superannuation funds where they're defined benefit funds. The government has indicated they would like to tax these funds in the same way, or not tax the fund, but tax the members of these funds in the same way. But they've got to design a system to see how that will work, because it's not easy for defined benefit funds.
Yep. And maybe we'll go to a different topic there with the downsizer contributions. Question there, is there an upper age limit?
So downsizer contributions. So no upper age limit at all on downsizer contributions. So I'd been using in my examples before that you could have someone in their 90s making a downsizer contribution. So I was quite comforted to see in Jeevan's data that in fact yes, he has had downsizer contributions. So no upper age limit at all. And it might even be somebody who uses a downsizer contribution as an opportunity for a withdrawal and recontribution strategy. They might not have any intention to be adding monies to superannuation, but at that age, they can't do a non-concessional contribution, so they can't do a normal withdrawal and recontribution strategy, but there's nothing to stop them from taking a withdrawal and putting in a downsizer contribution, provided they lodge the cap form on or before the contribution goes in, so it counts towards their downsizer cap instead.
And maybe sort of the final question there. Is there any predictions that you have for this year's federal budget?
Oh no, I wasn't anticipating the $3 million cap so quickly. I really thought we had until budget night before we had any information around that. What was the $5 million cap when they first proposed it, and then it turned into a $3 million. So I'm not sure that my crystal ball is any good at all.
Yeah, absolutely. So I think, Lyn, thank you for your time today. How can our attendees today find out more information about, I guess, Heffron and some of the services that you offer?
Excellent. So yes, so jump on to the website. I think we've got a post-event email coming out from your end, Jeevan. So we might be able to add some extra information into there in terms of things like our Super Companion. We mentioned of these standard instructions. We have a Heffron Super Toolkit that provides those sorts of instructions, the standing instructions as well. Otherwise, jump onto the Heffron website and you'll see our services and the future events that we have coming up as well.
Okay, thank you. So thank you everyone for attending today, and thank you, Lyn, for your wonderful presentation.
Thank you. And thank you for Sean and Andrea for answering those multitude of questions that have come in.
Yeah, I can still see them typing through. Any questions that we didn't get to, we will try and reply to, and we might even try and include, if we do have time, maybe a bit of a summary of the Q&A with the emails we sent out as well. Thank you everyone for your attendance today, and have a great day.
Thank you.
Bye.